You take one loss. Nothing unusual. You knew before entering the trade that losing was possible. But 5 minutes later, you're staring at the chart thinking, I can make that back. So you take another trade. That one loses too. Now you're not looking for the best setup anymore. You're looking for your money. And that's where one normal losing trade can turn into an entire day of bad decisions. The strange part is, you probably already know you should stop. So why can't you? Imagine you start the morning with a $10,000 trading account. Before the market opens, you're calm. You've made a plan. You'll risk no more than $100 on a trade. You know the setup you're looking for, and you're not going to chase the market. Then your setup appears. You enter. The trade moves against you, hits your stop, and you're down $100. At this point, nothing has actually gone wrong. You followed your plan. You controlled your risk. The trade simply didn't work. But psychologically, something can change. Before that loss, you were asking yourself, is this a good trade? Now you're asking, how do I get my $100 back? Those questions may sound similar, but they're completely different. The first question is about decision quality. The second is about recovering a loss. And once recovery becomes the goal, your standards can begin to change. This connects to one of the most important ideas in behavioral economics, loss aversion. Research on decision-making has shown that people don't always experience gains and losses in the same way. Losses can have a particularly strong psychological impact. For a trader, that means seeing minus $100 on the screen may feel more important than simply waiting for the next high-quality opportunity. Your account was at $10,000. Now it's at $9,900. And suddenly, $10,000 becomes a target. You want to get back to where you started. That's when a dangerous little sentence appears in your head. One more trade. You see another setup forming. Normally, you might ignore it. Maybe it isn't quite clean enough. Maybe you're entering late. Maybe one of your normal confirmations is missing. But right now, you don't see the trade in isolation. You see a chance to erase the previous loss. So you enter. The second trade loses another $100. Now you're down $200. And notice what happens. When you were down $100, you wanted to make back $100. Now you're thinking about making back $200. The urgency has increased. Maybe you start looking at a larger position. You tell yourself, if I risk $200 on the next one and it works, I can get back to even faster. And this is the moment when the problem becomes much bigger than a losing trade. Your original goal was to follow your process. Now your goal is to erase the red number on the screen. So you take the third trade. This time you risk $200. It loses. Now you're down $400. Think about the progression. The first trade followed your plan and lost $100. The second trade was weaker and lost another $100. The third trade was influenced by frustration, and you doubled your risk. The market didn't force you to do any of that. The first loss changed the way you approached the decisions that followed. This is why revenge trading can become so destructive. It often doesn't begin with someone thinking, I'm going to make a terrible decision. It begins with a very reasonable-sounding thought. I just want to get back to even. But once getting back to even becomes emotionally important, every new candle can start looking like an opportunity. You begin entering faster. Waiting becomes harder. Average setups start looking good. You may increase your size. You may move your stop. You may take trades that you would have rejected an hour earlier. And eventually, you're no longer responding only to what the market is showing you. You're responding to what the previous trade made you feel. That's the hidden part of overtrading. Taking too many trades may only be the visible symptom. The deeper problem may be your inability to accept that today might simply be a losing day. Think about that for a second. You're down $300. The market doesn't know you're down $300. The next setup doesn't know you're down $300. The chart doesn't care where your account started this morning, but you do. And that number can influence every decision you make next. This also explains why just be disciplined isn't always useful advice. Of course, discipline matters. But telling yourself to be disciplined while you're calm is easy. The real test comes after you've lost money. Now frustration is involved. Your desire to recover is involved. Maybe your confidence has been hit. Maybe you're angry because you were stopped out just before price moved in the direction you originally expected. You're no longer making the next decision under the same conditions as the first one. That's why you need a system that doesn't depend entirely on how disciplined you feel in the moment. The first thing you can do is decide when you'll stop before you start trading. Don't wait until you're angry to decide how much is too much. Make that decision while you're calm. That might mean having a predetermined maximum daily loss, a maximum number of trades, or another clear risk limit that fits your trading plan. The important part is that the rule already exists before the loss happens. The calm version of you is setting a boundary for the emotional version of you. Second, create space between a loss and your next decision. You don't necessarily need to immediately search the chart for another opportunity. Step away. Record the trade. Look at why you entered. Check whether you actually followed your plan. Give yourself enough time to separate the previous result from the next decision. The goal isn't to stop feeling frustrated. The goal is to stop frustration from immediately turning into another order. Third, ask yourself one simple question before taking the next trade. Would I take this exact setup if my previous trade had been a winner? Think about how powerful that question is. If you would have ignored this setup after a winning trade, why does it suddenly look attractive after a loss? Maybe the setup hasn't improved. Maybe your emotional need to trade has increased. That distinction matters. Fourth, stop judging every decision purely by money. A losing trade can still be a good trade. If you followed your setup, controlled your risk, entered for the right reasons, and accepted your predetermined stop, the fact that the trade lost doesn't automatically make the decision bad. And the opposite is also true. You can break every rule, take an impulsive trade, and make money. That doesn't make it a good decision. In fact, those lucky wins can be dangerous because they can teach you that breaking your rules works. Instead of asking only, "How much money did I make today?" ask another question. How many of my trades actually followed my process? That shifts your attention away from forcing a particular financial result today and back toward the quality of your decisions. Now think about your own recent losing days. What happened after your first loss? Did you start trading more frequently? Did you enter faster? Did you increase your position size? Did setups that normally wouldn't interest you suddenly become attractive? Did you stop waiting for the market and start trying to force the market to give your money back? And here's an even more interesting question. If you couldn't see your profit and loss for the day, would you have taken those same trades? Because sometimes the problem isn't that you don't understand trading. You may understand your strategy perfectly. You may know your risk rules. You may even recognize that you're overtrading while you're doing it. The problem is that after a loss, your objective quietly changes. You stop trying to make good decisions. You start trying to make the uncomfortable feeling of losing disappear. And the market becomes the place where you try to fix that feeling. That's a dangerous relationship with trading. You don't need to win back today's loss today. The market doesn't know your starting balance. It doesn't owe you break even. And your next trade shouldn't have the job of repairing your previous one. The real skill isn't avoiding every losing trade. That's impossible. The real skill is taking a loss without allowing that loss to rewrite the rules for everything you do next. Because sometimes the trade that does the most damage isn't the first losing trade. It's the trade you take because you couldn't accept the first one. But there's another side to this psychology. Losing isn't the only thing that can make you abandon your rules. Sometimes winning can be just as dangerous. A big winning trade can make you feel unusually confident, increase your willingness to take risk, and convince you that you suddenly understand the market better than you did an hour ago. And that's where the next psychological trap begins.